Navigating the unseen, decoding the black swan lurking beyond the horizon. We stand on the precipice of financial possibility, a landscape shaped by forces both visible and profoundly hidden. The market hums with predictable rhythms, the ebb and flow of established trends, the quarterly reports, the analyst upgrades. We diligently track these, seeking patterns, trying to decipher the whispers of tomorrow. Yet, lurking in the shadows, beyond the chart and the consensus, is the spectre of the truly unpredictable, the Black Swan event. It's a term that conjures images of sudden, catastrophic disruption, a force that, by its very nature, defies our attempts to forecast. But does that mean we are powerless? Does the inability to predict the precise moment of impact render us incapable of preparing for its potential arrival? Benjamin Graham, the father of value investing, offered a profound insight that cuts through the noise. The investor's chief problem is never the market itself, but always himself. This is where our journey truly begins. Our own cognitive biases, our innate desire for order and predictability, can amplify the shock when the unexpected strikes. We cling to familiar narratives, to the comfort of what we think we know, leaving us vulnerable when the ground shifts beneath our feet. The mainstream analysis, the accepted wisdom, often focuses on the quantifiable, the probable. It's a vital tool, but it can create a blind spot, a collective oversight that leaves us unprepared for the genuinely disruptive forces that can reshape markets overnight. Our mission here is not to chase phantoms or to claim the impossible gift of prophecy. Instead, we aim to equip you with a different kind of power, the power of a resilient mind. We seek to cultivate a framework for critical thinking, one that doesn't just react to the known variables, but actively prepares for the profoundly unknown. This is about building an inner fortitude, a preparedness that transcends mere data points and embraces the inherent uncertainty of our financial world. How do we navigate a landscape where the most impactful events are, by definition, unpredicted? That is the fundamental question we will explore together. The invisible hands malfunction. When systemic fragility becomes the unforeseen catalyst, we often speak of the market's invisible hand, a metaphor for self-regulating forces that guide economies towards equilibrium. But what happens when this hand, so to speak, falters not from a predictable tremor, but from an unseen, systemic weakness? We meticulously monitor economic indicators, the familiar metrics we believe signal the market's health. Yet, the true vulnerabilities often lie deeper, woven into the very fabric of our interconnected world. Think of the intricate global supply chains, the complex financial plumbing that facilitates trillions in transactions, the ever-growing technological dependencies that underpin modern commerce. These are not isolated components. They are a delicate ecosystem where a stress in one area can trigger a cascade of failures, an unforeseen catalyst for disruption. Consider it like a Jenga tower. We see the obvious blocks being removed, the headline-grabbing market shifts, the interest rate hikes, the geopolitical tensions. We brace for those impacts. But the true Black Swan event, the one that brings everything crashing down unexpectedly, is often a hidden structural weakness in the base, a fundamental flaw in the interconnected design that we've overlooked. It's the quiet vulnerability that, when finally triggered, causes the entire edifice to collapse with shocking speed. This brings us to the pervasive myth of too big to fail. We've been led to believe that immense size and complexity are bulwarks of stability, yet the inverse can be true. The very interconnectedness and scale designed to ensure resilience can, paradoxically, become the breeding ground for systemic risk. When a novel shockwave hits such a tightly woven system, the contagion effect can be rapid and devastating, far exceeding what any single entity could withstand. So, how do we prepare for such unseen vulnerabilities? This requires what we might call a fragility audit. It's about looking beyond the surface-level volatility and examining the subtle, interconnected fragilities within your own financial world. Where are your single points of failure? What dependencies, both personal and within your investment portfolio, could be stressed by a systemic shock? The fragility of our interconnectedness is the unseen architect of the next great market shock. The crucial question is, are you building your financial future on solid ground or on a precarious house of cards? The algorithmic echo chamber. How AIS dominance creates predictable instability. We live in an era where algorithms are increasingly at the helm of financial markets. Quantitative trading strategies, powered by artificial intelligence, now manage vast sums of capital, making decisions at speeds and scales far beyond human capacity. This efficiency, this optimization for profit, has become a cornerstone of modern investing. But in this relentless pursuit of the edge, are we inadvertently creating a new form of systemic risk? When a multitude of these sophisticated systems, designed with similar objectives and trained on similar datasets, encounter a truly novel situation, they can react in remarkably similar ways. This convergence of algorithmic behavior under stress becomes a predictable instability. Imagine a vast flock of birds. Individually, each bird possesses a remarkable ability to adapt, to navigate complex air currents. Yet, when a predator appears or an unexpected obstacle arises, their programmed herd behavior behavior can lead them into predictable patterns of danger. All at once, they might surge in one direction, becoming a concentrated target, amplifying the initial threat. Similarly, in finance, when a black swan event emerges, algorithms trained to optimize for specific outcomes might collectively trigger sell-offs or herd into perceived safe havens, not out of rational assessment, but out of programmed response, thereby exacerbating the very crisis they are meant to navigate. This drive for optimization, while seemingly beneficial, has a subtle but profound consequence. It can systematically erode the value of human intuition, of contrarian thinking, of the very edge that independent analysis provides. When every decision is dictated by code designed to achieve similar goals, the market can become a fragile consensus, a monolithic entity susceptible to a single, unexpected blow. The diversification we seek in our portfolios might be undermined by a lack of diversification in our decision-making processes. Therefore, a crucial actionable insight emerges. Diversify your information diet. This goes beyond simply allocating assets across different classes. It means actively seeking out a wider spectrum of financial insights, challenging the prevailing narratives, and cultivating sources of analysis that operate outside the algorithmic echo chamber. In a world increasingly driven by code, the greatest unseen risk isn't a random glitch, but the synchronized behavior these systems instill. Can your strategy truly outthink the code, or are you merely a participant in its predictable dance? The human factor ignored, behavioral blind spots amplifying unforeseen shocks. We often assume that in the sophisticated world of finance, rationality prevails. We believe that data, analysis, and logical deduction guide every decision. Yet, the most potent black swan events are frequently amplified not by market mechanics alone, but by the deeply ingrained behavioral patterns of the humans who inhabit it. Beyond the commonly discussed biases like fear and greed lies a more insidious force: collective psychological inertia. This is the tendency for groups, whether within large financial institutions or among individual investors, to resist change, to suppress dissenting opinions, and to maintain a comfortable status quo even when the ground is shifting beneath them. Consider the timeless fable of the emperor has no clothes. The black swan event, in many instances, is not entirely unforeseen. It is often perceived, or at least suspected, by a few insightful individuals. However, the overwhelming pressure to conform, the fear of being ostracized, or the sheer discomfort of challenging the prevailing narrative prevents these truths from being voiced. The collective denial creates a powerful blind spot, allowing the improbable to become the inevitable until the moment of revelation is unavoidable and the collapse is upon us. The myth of the rational actor in finance crumbles under this weight. The desire for certainty, the pressure to align with the consensus, and the suppression of dissenting voices don't just create an environment where surprises are more likely. They actively create the conditions for a black swan to exploit. When challenging the status quo is seen as a risk to one's career or social standing within the financial community, the most critical observations are silenced. Therefore, cultivating your inner contrarian becomes a vital strategy. This isn't about being difficult for the sake of it, but about developing a personal framework for rigorously challenging consensus. It means actively seeking out opposing viewpoints, even those that make you uncomfortable. It's about valuing intellectual honesty above social conformity in your investment decisions. When collective psychology overrides critical observation, the most obvious black swan can become the least visible. The question remains, will you be the one to see it coming and dare to speak its name? The geopolitical domino effect. Unforeseen black swans. In a hyperconnected world, we often compartmentalize geopolitical events, viewing them as regional disturbances, isolated conflicts with localized impacts. But in our hyperconnected world, the lines between regional instability and global economic shock have blurred into non-existence. A seemingly minor political tremor in one corner of the globe can, through the intricate web of international trade, sanctions, and resource dependencies, trigger a seismic shift across financial markets worldwide. The assumption that a problem confined to one nation or region will remain so is a dangerous oversight. This is the economic equivalent of the butterfly effect. A seemingly insignificant political shift, a localized policy change, or a minor diplomatic dispute can, when amplified by the vast machinery of global trade and finance, create a hurricane of market disruption far beyond its origin. The interconnectedness that facilitates efficiency and growth also creates a delicate chain reaction. A disruption in one link, unforeseen and unpredicted, can send shockwaves through the entire system, causing market volatility that appears disproportionate to the initial event. What are these overlooked risks? They lie in the very globalization that has defined our economic landscape. Modern supply chains, financial flows, and resource dependencies create profound fragility points. A black swan event originating as a regional issue, perhaps a political upheaval, a sudden resource scarcity, or an unexpected trade war, can exploit these vulnerabilities, transforming a localized problem into a systemic crisis that impacts economies on a global scale. The assumption of resilience in these interconnected systems is precisely what makes them susceptible to such shocks. Therefore, a crucial actionable insight is to move beyond simple risk assessment and embrace comprehensive scenario planning for geopolitical shocks. This means developing adaptive strategies for a diverse range of geopolitical what-ifs that could potentially impact your portfolio. It requires anticipating not just the probable, but the improbable, and building resilience into your financial strategy. In our hyperconnected world, the greatest black swan might not be an economic collapse originating from within the market itself, but a geopolitical tremor that shakes the very foundations of global stability. Are you prepared for the reverberations, the unseen black swan in your portfolio, hidden leverage, and unaccounted risk? We diligently select investments, believing we are building a robust portfolio. We look at the visible metrics, the reported earnings, the market capitalization. But in the intricate world of modern finance, what appears stable on the surface can often conceal a profound and unseen risk. This is where the true black swan event for individual investors often lurks, within the very assets we hold. Peeling back the layers of seemingly secure investments reveals how hidden leverage, complex derivatives, and opaque financial instruments can mask extreme risk, creating vulnerabilities we are entirely unaware of until a crisis strikes. Think of it as the iceberg of risk. What you see, the tip of the iceberg, the reported value of a stock, the stated terms of a bond, is merely a fraction of the true picture. Beneath the surface lies a vast, hidden mass of leverage, complex financial engineering, and interdependencies. When the market conditions shift, that hidden mass can destabilize the entire structure, causing the seemingly solid investment to capsize with shocking speed. It's a risk that is not apparent in the day-to-day price movements, but is fundamental to the investment's underlying structure. This brings us to the illusion of transparency. Sophisticated financial products, designed with layers of complexity, can obscure the true level of risk involved. They are often presented in a way that suggests safety and predictability, but when a crisis hits, their true nature is revealed, and the impact is far more severe than anticipated. The very instruments designed to manage risk can, in fact, become amplifiers of it when the unexpected occurs. Therefore, adopting the mindset of a forensic investor is not merely advisable, it is essential. This involves developing strategies to scrutinize financial statements with a critical eye, seeking to understand the underlying structures of derivative products and actively identifying any hidden leverage that might be at play. It's about looking beyond the marketing materials and the headline numbers to understand the true composition and risk profile of your investments. The black swan event is often not a surprise, but a consequence of risks so deeply buried they become invisible. The critical question is, are you truly seeing what's under the surface of your portfolio? Beyond prediction, building resilience against the unforeseen. We've journeyed through the shadows, exploring the nature of black swan events, those unpredictable yet potentially devastating occurrences that lie beyond the scope of conventional forecasting. We've seen how systemic fragilities, algorithmic convergence, human behavioral blind spots, geopolitical domino effects, and hidden risks within our own portfolios can all converge to create the conditions for unforeseen market crash. But the true lesson here isn't about mastering the impossible art of prediction. It's about cultivating a different kind of strength, the strength of resilience. The goal isn't to know exactly when or how the next shock will arrive, but to build a financial system, both within your investments and your own mind, that can withstand such shocks when they inevitably do. This echoes the enduring wisdom of Warren Buffett. Rule no 1. Never lose money. Rule no 2. Never forget rule no 1. When viewed through the lens of black swan risks, this principle transcends simple capital preservation. It demands a deep understanding of the unseen dangers, the systemic leverage, the behavioral traps that can lead to catastrophic losses, and a proactive approach to mitigating them. Our focus, therefore, must shift. Instead of obsessing over market timing, a fool's errand in the face of true unpredictability, we must prioritize building resilience. This means constructing a portfolio and, perhaps more importantly, a mindset that doesn't just function during calm seas, but actively thrives amidst uncertainty. It's about recognizing that volatility isn't just a temporary inconvenience, but an inherent characteristic of complex systems, and preparing for it accordingly. Your next step is clear. Embrace critical thinking with unwavering resolve. Continuously question the consensus, the prevailing narratives that lull us into a false sense of security. Conduct a thorough audit of your financial world, diligently seeking out those hidden fragilities and unaccounted risks we've discussed. The informed investor, the truly resilient investor, doesn't merely hope for sunshine. They prepare for the storm, armed with knowledge, foresight, and a deep understanding of the unseen forces that shape our financial destiny. What unseen vulnerability will you address first?